Hello, everyone, and welcome. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, March 17th, 2021, and I'm pre-recording this Trading Places Live for Thursday, March 18th. Futures currently are looking to extend the rally that we saw on Wednesday afternoon. All of our major indices are looking, right now at least, to open up maybe between 0.3 and 0.4% higher on Thursday. We'll see whether or not that carries over until the morning, but at least this evening things are looking pretty good. As far as our agenda today, we're going to start off with our daily market recap, as we always do, get into talking technically. I want to show you a little bit about what happened in the market after 2 p.m. when the Fed came out with their policy statement. Then we're going to get into chart lists, earnings spotlight, and we'll wrap up the show with the 3 you must see. Before we get into any of that, though, I do want to just take you over to earningsbeats.com. If you're not already a member or part of our community, you can sign up for our free Earnings Beats Digest newsletter. It comes out Mondays, Wednesdays, and Friday mornings, usually right before the market opens. And all you have to do is type in your name, email address, hit the subscribe button, and we will get you added to the list. There is no credit card required. You can unsubscribe at any time. It's very educational in nature, and it just gives you a little bit about how we look at the market from a earningsbeats.com perspective. Looks a lot at relative strength. We look at earnings reports, upcoming earnings reports, or maybe reports that have already come out, trying to highlight potentially some trading opportunities for our community members. If you'd like to try our service for 30 days without cost, you can click this green Join Today button. You will be charged $7 up front, but that will be refunded to you within a week. So literally no cost for 30 days. You can try us out. Portfolio is beginning to bounce back. We had a pretty rough go of it at the beginning of this quarter. Our new quarter started on February 19th, and that was literally just one trading day before growth stocks broke down versus value stocks. So we had a number of growth stocks and still do. And I think before this quarter's over, I think that's going to benefit us, but we'll talk about that more as we go throughout the show. But we were down quite a bit. We've rallied also quite a bit, getting closer and closer to the S&P 500. And our income portfolio, you can see this quarter, actually, we did make some changes in there, put some value stocks in there that were paying nice dividends. And you can see that portfolio is absolutely crushing the S&P 500. So overall, the 4 funds are not doing that badly, but these 3, where you can see the red this quarter so far, still has some catching up to do, but I think we're on our way. All right, let's go ahead and move on to what happened on Wednesday. It was a pretty big day for the market. We had the Fed coming out. I think there was a lot of nervousness heading into this Fed report about what the Fed might say or do about inflation, about the rise in the 10-year Treasury yield. You know, what are they thinking in terms of potentially raising the Fed funds rate? And all of that kind of came and went without really much change at all. We'll talk about that in just a couple minutes. But the Dow Jones Industrial Average was up 190 points, closing above 33,000 for the first time in history. Just a couple weeks ago, we went above 32,000 for the first time in history. And don't be surprised if it's not too long before we go through 34,000 for the first time in history. S&P 500 up 11 points, 3974, creeping closer and closer to 4,000. The NASDAQ up 53 points, back to 13,500, and also, more importantly, back above both the 20-day and the 50-day moving average. Good action there. Mid-caps up 17 points, or 2/3% roughly, back to 2664, nearing another all-time high, and small caps up almost 0.75%. Rising 8 points to 1381, and it too is not far from setting a new high. All the AD lines on the major indices turning back to the upside, looking very strong. What's really maybe a little more surprising is the fact that the NASDAQ, which is still a solid 500-600 points away from its all-time high, is setting a new high in terms of accumulation distribution. So it does make me think that a lot of this selling over the past 30 days or so has been somewhat orchestrated with more gap downs and buying throughout the day. That's how that accumulation distribution continues to set new highs, even though price action's been going down. I think that's a really, really positive sign for the market. Discretionary stocks leading from a sector perspective, rising 1.4%, and also getting close to that February high. This is one of the aggressive areas of the market that were beaten up a little bit. This area was beaten up over the course of the last 30 days. You can see the huge drop from about 174 all the way down to 150. But we've come back and gotten almost all of that back here just over the past 2 weeks or so, two to 3 weeks. Industrials had a strong day, also rising more than 1% and not far from its all-time high. Materials continue to do well, up almost 1%. Those were the three best performing sectors today. Utilities, the worst. So with the Fed basically coming out and saying, hey, we're not raising rates, utilities sold off. I mean, we had seen a pretty big move up in utilities. The defensive areas overall just sold off, and money rotated back into the aggressive groups. And I'll show you exactly how you can look at that and visualize it in just a second. But utilities, after a really strong move over the past couple of weeks, definitely saw some profit taking on this announcement by the Fed. Home construction really benefited. It was already benefiting even before the announcement came out. And this was the group that I actually featured in my daily market report that I sent to Earnings Beats members this afternoon, right before the Fed came out with their policy statement. But they were, the group was already breaking out, which I thought was good news for the economy. I mean, we've had some not so great economic reports in this area. Housing starts and building permits came out yesterday, and both were way below expectations. Of course, interest rates have been rising. You would think the combination of those two would really have home construction reeling. And instead, we're trending above the 20-day moving average and breaking out to another all-time high. So I like what I'm seeing here with home construction, and I think that tells us something about the state of the consumer going forward and the state of the economy as we move forward. That's a really good sign, in my opinion. Look at the volume confirming that move to the upside. So really good action there. Moving on to the 10-year Treasury yield. All right, so the Fed comes out at 2 o'clock today. Didn't change a whole lot in their statement. They didn't refer to energy as they did in the prior month. They essentially, they're still looking for, growth continuing. They're seeing signs of things picking up. And if you look back, I think it was their December statement or in the December meeting, they looked at GDP, and I think they were forecasting, I don't have the number in front of me, but I believe it was 4.2% or 4.5%, something like that. And they are now saying GDP for 2021, 6.5%. This is what I've been talking about. I said, I thought minimum would be 6%. I still think there's an outside shot we go to 7%. Maybe it isn't even an outside shot. I think there's a reasonable chance that the GDP this year is 7%. Now, I know everybody's getting all up in arms. Oh my gosh, interest rates are on the rise. Okay, folks, they're at 1.64%. That's about where we were when the pandemic hit. So all we've done is kind of normalized back to where we were. But now we've got GDP anticipated to be 6.5% by the Fed. And I think that'll continue to go up. Furthermore, again, they talked about inflation coming in over the next couple of months, year over year, that it's going to go above 2%. And they're basically saying that's okay. We're not going to make any changes to interest rates as a result of inflation. We're okay with inflation running above 2% for a period of time. So honestly, I think this is nirvana for the growth stocks. Higher economic activity, promising not to do anything with interest rates. I mean, again, they're talking about 2023 before thinking about interest rates. Now, there were more committee members that did suggest that, we should be raising rates either later this year or maybe next year. I think there are 18 members on the committee. And I think the number that thought we should raise next year went up from 5 to 7 of those 18 members. And I think this year went from 1 to maybe 3 or 4. I'm not sure. I don't have the numbers right here in front of me. So there is a growing number of members that believes that maybe we need to be thinking about raising rates, but it's still not a majority. I mean, it's nowhere close to a majority for this year. And even next year, only 7 out of 18 right now are thinking about it. So I kind of looking at the Fed and what they're saying is that we're going to keep rates low. We're going to have growth off the charts. It's going to be the best GDP year of the century. And inflation, yes, it's going to tick up a little bit, but we're okay with that. I don't know what else could have been said from a growth perspective to encourage investors to jump back into growth stocks. I still think, based on everything I saw in the Fed statement and based on what I'm seeing on the charts, I think staying away from growth is not the right answer. That's, again, just my opinion. We'll see how these things play out. Now, we are still in March. Maybe things continue the way they've been for the next couple of weeks, but I really believe when we start focusing on earnings season, I think money's rotating back to growth. And everything that the Fed said today has me thinking that as well. All right, tomorrow morning, Thursday morning, we do have initial jobless claims coming out. The expectation is for 700,000 claims. Last week was 712,000, so we're looking for improvement there. March Philadelphia Fed Manufacturing Index, February was 23.1. We're expecting March to come in at 24, so slight improvement there. And then February leading indicators expected to rise 0.3%. January rose 0.5%. So overall, economic reports, at least what we're expecting for Thursday, looks pretty good. The Fed's behind us. We do have options expiring on Friday, and that could still create some craziness here over the next few days, a couple of days this week, and then maybe even into the early part of next week. But beyond that, I really think once we get beyond options and, get beyond March, which typically we see defensive groups do better during March and aggressive areas not as well. I think once we get this under our belt, get past it, I do expect things to rotate back to growth, and maybe sooner. We'll see. Maybe it started this afternoon. But okay, I want to move into talking technically because this is, I think, really important. What I have up here is a 5-day, 10-minute chart, and on the top you'll see the S&P 500. So this is just 5 days. There's the 1 day, 2 day, 3 day, 4 day. And then the rest of this was Wednesday's action. The vertical black dotted line that you see here is right around 2 o'clock. So this is when the Fed announcement came out. So top panel, S&P 500. Then we go down technology relative to the S&P 500, consumer discretionary relative to the S&P 500, communication services relative to the S&P 500, industrials versus the S&P 500, and then financials versus the S&P 500. So I wanted to look at how the aggressive areas performed after the 2 o'clock announcement. Now you can see for about 24 hours, a little more than 24 hours, technology was not performing well heading into this report, and then just started to tick up right before the 2 o'clock announcement. After 2 o'clock, we had a nice move up, saw a little bit of profit taking in the final hour, but we definitely went higher from 2 o'clock to 4 o'clock. Consumer discretionary, this was the strongest group in my opinion after the 2 o'clock announcement. I think the consumer discretionary did well, and that was home construction's part of this group, which I just talked about a little bit ago. Communication services strengthened. Now, industrials and financials immediately went down in the first hour, but you can see they both came back in the second hour. So I think overall, the aggressive areas reacted about the way I would have expected. Some of the areas that were beaten down the most recently, especially consumer discretionary, got a really nice lift after 2 o'clock. I think technology saw a big move, even though we pulled back in the final hour. I would expect this to continue in the future, but we'll see. Again, we've still got March to deal with. Now, on this next chart that I wanted to show you, it's the same thing, 5-day S&P chart, but it's the other six sectors on here. So here's consumer staples, defensive. Look at 2 o'clock. After 2 o'clock, straight down relative. Utilities, defensive group, straight down on a relative basis. Real estate, a defensive group, down, came back a little bit. It was down slightly over the last couple of hours. Healthcare, more defensive, straight down after 2 o'clock. Energy, mostly flat, down, then came back. Materials, mostly flat. So didn't really see much change there. But can you see the shift at 2 o'clock from defense to offense? So the defensive groups were losing ground in the final 2 hours, and the aggressive groups were gaining ground in the final 2 hours. I think that's important. Now, we'll need to want to continue to watch this to see whether or not it continues. But at least for now, I really like what I'm seeing. Now, in particular, I want to zero in on this consumer discretionary area. So the next segment, chart lists. I want to show you a little bit about what we do at Earnings Beats, the research platform we put together for our members. And let me show you, now that you see what's going on in consumer discretionary, I've pulled up 4 different chart lists that we allow our members to download. Members can view all of our charts in our chart list, whether you're a StockCharts member or not. But if you're an extra member or a pro member, and that gives you the ability to have up to, I think extra, you can have up to 250 chart lists in your account, and pro members can have up to 350 chart lists. Well, we do chart lists at Earnings Beats, and we provide our members links. Now, if you're not a member and you click on the link, it's just going to give you one chart at a time, kind of a thing. You can go through and look at them. But if you're a StockCharts member, extra or pro level, you can take our chart list and drop it in seconds right into your StockCharts account, which is awesome. So here's one of our strong earnings chart list. We now have more than 500 companies in our strong earnings chart list. We have 2 of them, and you can only have 500 companies in a chart list. So we had to make our second chart list because there are so many companies that are beating Wall Street estimates, top and bottom line, and are beginning to look much better technically. They're rising. I mean, we're getting wide participation in this advance. And this is what I've been talking about with a secular bull market. We see everything starting to move higher now. And we keep a list of the best earnings reports for our members, which I think is tremendous. I think it saves so much time. And the beauty is we've already done all the research. So these are companies, when you look at the strong earnings chart list, you don't have to go and check out and see what they did with earnings. You can go to our website. We give you the numbers, revenue and earnings per share, both the actual and the estimate. All of it's on our website. And then you can come in here and just look immediately at the charts. But what I want to do here is just show you, if you type into the search box. So I've gone up, I pulled the list up, and then I went to when you can view your list in all these different ways. I'm viewing it on summary, as summary form, and then type in the search box discretionary. And here's the sector. Here are all the discretionary stocks that show up in this particular strong earnings chart list. And you can see the industry group that they're in. Right now, I've got them sorted in scooter order. And you can also, change it and sort it in percentage change. You can see what really did well. Look at this: home construction, home construction, home construction, home construction, home construction. So 5 of the top, 13 or so stocks were home construction. You can see autos, auto parts, gambling, auto parts. You can get a really good sense of what was working today. So you look at the 5-day chart and see where the money was going after 2 o'clock. And then you can come in here and quickly look at this, look at our various chart lists. So here's the other strong earnings chart list. This one doesn't have as many companies on it, but you can do the same thing. Type in discretionary and the percentage change. Specialty retailers, there's a home construction, Toll Brothers, hotels, recreational services, automobiles, and so forth. But you can look right down the line, or you can sort it in scooter order, whatever it is. You can look at the ones that didn't work out today. Apparel retailers. Look at Macy's. Scooter at 99. It was down 2%. That might be setting up an opportunity. You pull up the chart and we annotate. So here's the key support levels that you can see we've been bouncing off of. I would actually now, because we've had this breakout, I think a pullback down around $18 would be a pretty solid entry into Macy's. So if you get a little bit of weakness, I think that could be an opportunity. Then we've got strong future earnings. So these are companies that are performing really well. They've got very solid scooters, but they're not on our strong earnings chart list. So either they're getting ready to report or they reported and for whatever reason, they just didn't beat top and bottom line, one or the other, maybe both. And so we keep a strong future earnings chart list for companies that are still technically sound, but don't qualify for our strong earnings chart list. And once again, you can do the same thing. Type in discretionary and you'll get a quick idea, percentage change. And there you got apparel retailers, travel and tourism, which I've been talking about quite a bit, apparel retailers as well. You can get a really good sense of what's working in the market. And again, I think it's just a quick way to zero in. You got Boot Barn, which has been sideways consolidating, but had a really strong day. Volume started to pick up a little bit. Maybe we get that breakout tomorrow. But these are all things that you can do looking at our portfolios or our chart lists. And then you've got raised guidance. So you want any company that's raised its guidance in the past couple of months, 2-3 months, is on this list. So again, you type in discretionary percentage changes, and then you can see what's now this one actually GRWG raised guidance twice in the last 3 months. That's kind of an interesting thing when you get a company that raises guidance twice, and especially after it got hit for a good solid month down to $33. Now it's back up. It's gone up almost probably 65% off that low in just the last 7 or 8 trading days. Pretty big move back to the upside, but GRWG I think looks good. And then on the charts, we'll always put a black dotted vertical line to mark where the raised guidance came in. So this one came in here, but if you go to the second one, you can see that's over here. So the other one was over in this area somewhere, and then this one came in later. So pretty interesting stuff, though, that we provide to our members. All right, let's move on. We got earnings spotlight. I'll tell you what, these earnings that came in after hours on Wednesday, there were some really, really nice reactions. Nice reports, too, by the way. But we'll start off with one that wasn't great, and that is ZTO. This is ZTO Express. The company missed 24 cents versus 25 cents on the bottom line. It was down 4% after hours. AD line's just been kind of so-so. Notice, and this is why from a trading perspective, it's so important to realize where those prior highs are, the really big important ones. You can see back in July, we got up to 39, went all the way back to 27. And when we got up to 39 again, put in a reversing candle. That's a bearish engulfing candle. And right back down we went. That is one of the reasons why I like to trade as opposed to invest. Because you invest in a stock like this and you can just see you're in this thing for months and months and months, and it just goes up, it goes down, it goes up, it goes down, it ends up going nowhere. So why not take your money and look for other opportunities? That's kind of the way I view it. But anyway, ZTO not looking particularly good. And if you look at the relative strength, I mean, just a couple months ago, we were at a 52-week low, started to strengthen, then rolled back over again as soon as we hit that resistance level. But let's look at some of these others. First of all, UPST, this is Upstart. This company was up, or last time I looked, up 48% after hours. They came in with revenues of $86 million versus $73 million expected. Bottom line, 7 cents versus 3 cents. And they announced they were acquiring company Prodigy. And as a result, stock up 48%. They also raised guidance for Q1 and fiscal year 21 revenues. So they're raising them higher. Just a win-win-win. And so the stock up 48% after hours, which would take it up almost 50. That's probably about $28, something like that. We're probably up at around $90. Now, it's not a breakout, but that's a pretty big jump in one evening. So we'll see what happens tomorrow. Another one I wanted to mention was Williams-Sonoma. Really solid report here. Revenues $2.29 billion versus $2.18 billion. Bottom line, $3.95 profit. Market was only expecting $3.39. They increased their dividend by 11.3%, and they approved a new $1 billion share repurchase plan. All of that after the bell tonight. Stock's up 12.5%, and looks to me like it is going to be ready to break out and gap up above that prior high in January. So Williams-Sonoma looking very good. And this is a stock that's been doing well relative to the specialty retail group, as opposed to what I showed you on ZTO, where a couple months ago we were at a 52-week relative low. Well, here a couple months ago we were at a 52-week relative high. So WSM definitely getting some love on Wall Street. Now we know why. Another one, this is a small company, but I really like their report, AOUT, American Outdoor Brands. Once again, you can see this stock trending higher, AD line strong, relative strength. Less than a month ago, before all this selling of growth stocks kicked in, you can see AOUT was at a 52-week high relative to recreational products peers. So it looked really good on a relative basis. And the stock after hours was up 10.25%. They crushed the revenues, 82 million versus 59 million. The bottom line, 82 cents versus 38 cents expected. And they guided fiscal year 21 revenues and earnings per share higher. I mean, some really good reports, like I said, came out after the bell. Others doing well after the bell. FIVE, which is 5 below. SMTC, Semtech also did well. Both those companies raised guidance in addition to beating top and bottom lines. So we had some good reports come in after the bell. Tomorrow morning, we're going to have ACN, Accenture, Dollar General, DG, among a few others, but some pretty decent reports coming out tomorrow morning. All right, let's get into the 3 you must see, and let's wrap things up here. I thought what I would do is take the 3 worst performers, or 3 of the worst performers on the S&P 500. And the worst performer on the day was NRG Energy. And they came out and announced that that severe cold weather in Texas was going to result in lowered guidance, earnings per share guidance for the company. And so obviously Wall Street wasn't excited about that. You would think that those in the know would have had some idea this was coming, but stock was trading at a high prior to this announcement, and then quickly went down to about a 2-3 month low, around 36 bucks. I think it needs to hold this, I'm going to say 35.5 to 35.75. Otherwise, potentially it could go back down here to some of these lows, either at 30 or at 28. So we want to keep an eye on that. All right, next up, Viacom was on the list. Now, this is a stock. It's in one of our portfolios. It has been on fire. And last night during our Max Payne webinar with members, I told members you're going to have to be careful with this one short term, because there are options, a lot of in-the-money call options. And so the stock could have some problems as we go into option expiration Friday and perhaps even the early part of next week. So I was not at all surprised when we dropped down as low as 86. At one point, the stock was down almost $10 today. And I think a lot of it was options related. Overall, I love the stock, though, and I think it goes higher. Just be careful short term. And then the last one is FTNT. I like this stock. I mean, I like the breakout. I think we're just pulling back. Watch that rising 20-day and watch price support around 175. So 175, 176 should be pretty good support. All right, that is it for me today. I hope you enjoyed the show. I'll be back next Monday for your next Trading Places Live over at earningsbeats.com. That'll start at 9 a.m. Eastern. Hopefully, see you there. Everybody, enjoy the rest of your week and your weekend. See you on Monday. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.